Welcome to the second pillar of the four pillars of investing. In this segment, or in this section, I should say, we're going to delve into technical analysis. And the nice thing is it sounds technical, but we're going to make it simple. So, as is our habit, always at the Cashflow Academy, is to show respect for our student and respect for you in a heartfelt congratulations. Chances are, if you're in technical analysis coming into this section, you've probably completed fundamental analysis, which is no small task. That's a long journey, and I hope you've reviewed it once or twice. I hope you've tried to glean everything and not rush through it. I hope there's been times where you've watched a segment more than once and taken notes. And I hope your coaches and the exercises you've done, if you're in our coaching program, have helped as well. So what's in this next segment for us? Well, we're going to, as always, when we start a new pillar, we set the context. We till the soil so that we're ready to receive the seed, right? Even great seeds don't grow in stony soil, no matter how good the seed is. So we're going to take a moment and review our context of how we learn and our education continuum and all those types of things. Price action is supply and demand. We'll talk about that and time frames and begin basic chart patterns in this first segment. Then we'll move on to more elaborate chart patterns. We'll look at candlesticks, moving averages, all types of things, tons of stuff. And you'll really get a good basic foundation of technical analysis. And just like in fundamentals, one of the things I said is, hey, as you go through this, things will click and you'll say, oh, I see why investors would care about this. And hopefully that's happened. Here, what's going to happen is very much the same thing. You'll say, oh, I see why they would use both and not just one. And it'll make a lot of sense to you. And it should also be a lot of fun to have those illuminations. So whether you're a trader that's been for a while and you're going to review some technicals here, I'm sure there's some nuggets in here for everyone. I know that there's been times where I've gone to a class as someone who has at least some experience in trading, where I thought, I probably know more than this instructor. That's happened to me many, many times. Maybe that's just my ignorance or my arrogance. But I'll tell you what, I almost always get stuff out of it. So if you're brand new, this will be a fire hose. If you're a little more seasoned, there'll be some great insights. Say, you know what, that insight alone was really worth the time to learn the four pillars. And boy, I got reviewed and clarity on some of the stuff I'd forgotten. Really good perspective on fundamental analysis. This stuff can get hairy, or technical analysis. This stuff can get hairy. And I take a lot of pride here in simplifying concepts that can kind of get overrun. There are hundreds of technical indicators, hundreds of them, maybe thousands. And people try to find the secret sauce, and I think a lot of it's because they go about it in a different mindset. So we're going to make this simple. Again, our disclaimer is always the same. It is about education. If I choose to use some real examples, please, 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 don't interpret that as a recommendation. It's not. It's to illustrate a point or to show something. Look, I use a real stock only because we like to be fun, simple, and real. And if people, there just tends to be a comfort level if we use a real stock. But I also love to show ABC and XYZ and Acme, because it really doesn't matter if it's a fictitious stock or a real stock. You learn the same thing. But I do throw real stocks in just to have that feeling of reality. It's like, okay, that really does happen in the real world. It's just a confidence builder, I think. So there's risk involved in this stuff. That's why we learn it. Respect the risk. We don't fear risk as much as respect is a very healthy way to approach it. And let's hop in with our context. So remember, you'll learn better if you have better expectations. We'll learn better if we have better expectations. If your expectation is to go from not understanding to understanding it in the blink of an eye at one point, that's really not the reality of how this works. It goes from not knowing how to do something to knowing how over time. If you have that expectation, that context, this will be more fun for you. Next, knowledge and behavior are two different things. And there are ascents to both in personal development. As I've looked at personal development and how important it is in an investing education, in a basketball education, in a marriage education, a family education, in any types of education we have, there's a pursuit of an intellectual ascent and then a discipline of behavior once we make the ascent. Often in my life, there's a chasm that I'm uncomfortable with. I'm failing because I don't know something. I lack education. Or maybe I have the knowledge, I've had the education, but I failed to implement and my behavior is not congruent with my knowledge. And so teachers help us with this ascent, coaches help us with this ascent. They're both extremely valuable. This is very, very valuable only if this happens. The knowledge, the value of the knowledge is lost without this. And so to capitalize on knowledge, we take action, we develop habits, and that is the essence of personal development that I've found. Learning things and doing things, learning things and doing things. It's a great journey in personal development, and this program is no different. If we take a family, marriage, and family class, we're going to learn about interpersonal relationships, but there'll be behaviors to adopt. If we're going to learn about a musical instrument, there'll be knowledge to be had, but habits and tremendous rigor on the piano, on the drum set, on the guitar, to be able to bring the knowledge into something we can do. It is no different here. So it may seem repetitive that with each pillar I speak about this. Well, this comes from over 20 years of experience as an educator all over the world. When I see people fail, it's one of those two things they lacked, and that's it. There isn't a third. It was knowledge or a behavior, and that is called personal development. If you look at the people I know who have $1 billion, okay, and I have some friends who have $1 billion. I'm not at $1 billion yet. Never would pretend to be. But as you pursue that $1 billion number, right, as you and I go after, or maybe yours is a $10 million number, whatever your number is, I will tell you that the guys I know that do well have those two things in their personal development. They're seeking knowledge, but they also have discipline, integrity in moments of choice to implement what they've learned. And the coaches that they use and the teachers that they have are what really makes that difference. So knowing what to do, doing it. The education continuum was developed to keep us humble and to keep us safe. I know for a fact that some people, while I would never want to curb the enthusiasm, their enthusiasm to get rich, the greed that we feel to have a result, the chemicals that flood our body when we visualize success get people really pumped up. You know, I've been in a lot of meetings and a lot of seminars where there's a lot of music and a lot of lights and a lot of energy. And the reason those do so well, you know, I've never been to a Tony Robbins seminar. I really like to go someday. I think I like to get pumped up. I know for a fact that when people visualize a future that is better than the present circumstance, that releases endorphins and it gets people excited. So sometimes when people experience illumination, which is awareness, with their enthusiasm, they confuse with what the continuum is. They feel they've had an arrival when they become aware. They feel they've come to an ending point, that there is nothing to continue on. Oh, I get it now. Oh, okay, so this is what an option is. Great. And they realize that there is another jump to really understanding it thoroughly, and yet another jump in behavior to become proficient. I will tell you, the market, if you do this a long time, my feeling is that the market would demand proficiency of me. You know, you might see that a different way, and that's okay. I'll just share that as my humble opinion. So again, the 4 pillars is separated in 2. The first are about gathering information, and if you went through fundamental analysis, hopefully you found that very rich to say, wow, there's so much I can do personally, so much I can learn about companies, and so much I can learn in the sovereign level. And that this was a very rich experience for you to learn fundamental analysis. And it will take practice and time for that to sink in. I don't know how many hours we spent on fundamental analysis. Might have been, 6 or 7. That's a lot of information to absorb when we're going through that amount of information. And so technical analysis will possibly be similar. We'll see. But it's all about gathering the information. We'll figure out what to do with this information, the next few pillars. But this was about how to find fundamentally sound companies, or how to find companies who are not fundamentally sound, to find opportunities possibly the short side, to have warnings, to know the future, to have a good idea, to at least give a checkup. Well, now we're going to go into technical analysis, which is an entirely different type of information. I will reiterate here is that the reason we gather information is our feeling and opinion is that a person can be more effective by gathering information than just putting a list of stocks on the wall and throwing darts and hoping for the best. This little illustration here of darts being thrown at a list of stocks is what diversification is all about. Let's just buy a whole bunch of stuff and hope the winners outnumber losers. The more darts we put on there, the better. The less amount of money we have in place, the better. We've learned that that's definitely not Benjamin Graham's way. It's definitely Warren Buffett's way, and it's definitely not a George Soros way to do this. It's certainly a great way for Wall Street to make money off mutual funds, off people. It's a great way for John Bogle to put us into the Vanguard fund. But if you look at Warren Buffett, he will say that diversification makes very little sense for people that know what they're doing. So we're going to gather information, and we're going to make decisions with intel. After and if you have intel, that means you can be an intelligent investor or make intelligent investments. An intelligent investment has very little to do with the outcome. You can have a very intelligent investment that doesn't work out well for whatever reason. What an intelligent investor does is they gather intel and they make the decision based on what they know now, understanding that the future could change. Our feeling, though, is that if we do a fundamental analysis and technical analysis, we have more intel than if we just threw darts to stock chart. And the real salvation is in risk management. So in looking forward to that time where we'll eventually get to risk management, please do not expect yourself to be right all the time. Warren Buffett has always made intelligent investing decisions. Every decision he ever made has been intelligent because he did it by using intel, by using information. Now, they haven't always made money. So please separate the idea and see if you can strive to understand that. I don't care if you agree or disagree with it. That doesn't matter. But strive to understand that. What is an intelligent investing decision? It's like a marriage. What do I want in a spouse, and what do I bring to the table on my side? What would make us happy? If we consider those things as we go out to court a spouse, then we're making an intelligent decision. Now, you might still get divorced, but at least you took some time to think beforehand, what are my attributes? What are the chances of this working out? Enron. So this is fun. In the last segment, we talked about 10Qs and 10Ks and the stuff that have to be put into the Securities and Exchange Commission. And there was a company you may not remember if you're younger, but if you're older like me, you'll remember this. There's a company in Texas called Enron, and they were not good people, man. They were really not good. And their stock's up, $80, $90 a share, flying high. And interesting stuff here. The head guy, Jeffrey Skilling, steps down. He resigns. And that's the captain leaving before the ship sinks right there. And the guy that took over was quite a character. His name was Ken Lay. And so he's in a press conference here, and Bloomberg published this, and they say, hey, here's the question, Ken Lay. There's been some concern among investors that perhaps there's more to his resignation, meaning Jeffrey Skilling, than meets the eye. In fact, perhaps there's some accounting issues or other issues that have not come to light. Is there anything more? And so they're flat out saying, look, investors are questioning your fundamentals. They're questioning the fundamental analysis. They're questioning your 10Qs, your 10Ks. And here's Ken's answer. He says, there are absolutely no problems that have anything to do with Jeff's departure. Lie. There are no accounting issues. Lie. There's no trading issues. Lie. No reserve issues. Lie. No previously unknown problems or issues. I mean, these are blatant, bald-faced lies. Uh, the company is probably, it's just so funny to hear this. And people are credulous. I mean, here he is being pinned down, asked point blank if there's problems. And not only is he saying there's no problem, he says we're probably in the strongest shape we've ever been in. Now that is just a flat out lie, and people are credulous to this. And there's always going to be the Ken Lays. Now, thankfully, most companies don't have a Ken Lay, but there's always going to be the one or two. There are no surprises. We did file our 10Q with the SEC a few days ago. And if there are any serious problems, they'd be in there. And if there's anything material and we're not reporting, we'd be breaking the law. We don't read the law. So this should have more meaning to you after doing fundamental analysis. You know what a 10K is. You know what a 10Q is. We went into Blockbuster videos. We saw that one of the sections in a 10Q and a 10K is risk factors, where they have to say if there's something material, meaning that if it matters, if it would have an impact, they got to put it in there. They're going to jail. And certainly they didn't do it well. So the chart is the reality. You can say whatever you want, and the fundamentals only come out 4 times a year. But what we're going to find is there's more to price and how stocks move than just how well they're doing as a company. And a person who would have traded Enron technically, especially from a risk standpoint, would have been able to not only save their money but capitalize on the downward movement with shorting the stock technically. And so this thing went all the way down to zero, of course. It was a huge problem, many people harmed. But cash flow from the stock market is really an educational process. And so we look at the fundamental analysis, which is the balance sheet, and then we look at the technical analysis, which is the stock chart. And of course, people with big trade stations look at these stock charts, right? When you picture someone who's a trader and a day trader, which I'm not, they have charts all over the place, and they're looking at the price movement of the charts, making decisions. And while I'm not a technical or a day trader, I care about technical analysis, and you'll find the reason why we all will likely care about it. So let's do this first segment just on what the supply and demand is and how this works. So like in any other market, the stock itself is a product. So think about that for a minute. The stock itself has a price fluctuation, not based on its fundamentals, but actually when it comes down to it, how many people want to buy today and how many people want to sell today. Stocks are a forward-thinking instrument, meaning that, yeah, we look at the fundamentals and their earnings, but we also look at their growth, and the growth one's the hard one. Earnings we can see because they're here, and past growth we can see, but future growth and earnings is very hard to predict. And so we have a degree of speculation that many people engage in. I don't know that I'm that much of a speculator, but there is a lot of speculation that goes on. And so we have buyers, scratching their chin, thinking, well, should I buy this? What should I pay? And sellers thinking, I'll offer you this, if you'll buy my stock from me, here's my asking price. And in the middle of all this, there's someone called a specialist or market maker. And the best thing I found, it's probably a poor metaphor, but it's the best one I found so far is if you go to Vegas and you look at a bookie, the bookie in the sports, the sports betting room doesn't really care about who wins or loses the game. They're just concerned about matching up, people who think there's going to be a win or a loss or point spread. And it's very much the same thing here. It's like a bookie where there's a guy that matches these people up with buyers and sellers. So the question that the buyer would be asking of the seller is very simple. The buyer would ask, hey, what are you asking for this stock? And the seller would say, well, my ask price is $51.26. So that's the question he's asking. Hey, seller over here, what are you asking for this? And the seller says, my asking price is $51.26. So there's an asking price for stocks. And if I were to put in just a market order saying, I want to buy it right now, click, with no limit on it, just buy it, that's the price I would likely pay, is $51.26. There's a a real good chance I'd wind up paying 51.26 because that's what he's asking. I just look, I want to buy it. I'm not going to haggle with you. What's your asking price? I'm not here to haggle. Now, of course, the seller, if they want to sell something, they might ask this guy a question first. They might say, well, what are you bidding for this stock? What are you willing to bid for this thing? And here we can see the bid price is 51.24. And that's what the money the seller would receive. So there's 2 cents missing. If the buyer pays 51.26 and the seller receives 51.24, there's 2 cents missing. That's called the spread, and the market maker will put that in his pocket. So this is unsettling in a way, because think about this. Does the market maker care about fundamentals? In fact, does the market maker do any research? Let's say he's representing Procter & Gamble up here, or whatever it might be at 50 bucks. Do you think he's even done a fundamental analysis on his stock to determine what it's worth? No. All the market maker cares about is getting as many people to buy and sell as possible. This is called liquidity, and it's one of the reasons that the stock market is a liquid market, meaning that you can always trade stuff very readily. If you want to buy something, you can generally buy it. If you want to sell something, you can generally sell it. Think about that. I have stuff in my garage that I could put on OfferUp or eBay. I don't know if it's sell today. If I put a for sale sign out in the front yard with my house, unless I made it way cheap, if I wanted any kind of profit from this house at all, in a fair price, it might take a few days to find that, that buyer. But the reality of it is, in the stock market, these market makers or specialists provide liquidity. They match these guys up, and they stand ready to provide that liquidity. And so if you're going to take a Series 65 someday and get licensed to do a hedge fund or something, one of the questions on that Series 65 might be, what's a market maker? Maybe one answer, or part of an answer, would be, what's a person or an entity or a man or woman who stands ready to provide that liquidity in the market. That makes sense with the name of the title, market maker. They make it so there's a market. They make the market happen. They make it so these guys can be lined up, buyers and sellers. So if there are no sellers, what would happen? If there's all these buyers and there's no sellers, well, how would you bring sellers to market and make a market for sellers? If there were all these people wanting to buy the stock, and there weren't enough people to sell it. Well, you got a problem. Here you got all these people wanting to buy a stock going crazy, but there's no market for it. So how do you make a market for that? Well, drop the price. Or raise the price. If you jack up the price, sellers will show up, right? If all of a sudden you own gold and all of a sudden people start saying, hey, gold just hit $2,000 an ounce, there's going to be some people willing to sell there, right? And so by raising up the price, you can attract more sellers. Now, what's disconcerting is we just did all this work on fundamental analysis. We just did all this work trying to figure out what something's worth. And see, now we're on the other side of it. Instead of a value investor, now we're a price investor. See that? Now we're looking at Zion and LeBron and saying, all right, what should we pay? And we come up with our own fundamental analysis and say, well, this is what we think we should pay. Then you go to market, and some people think LeBron or Zion's worth a little bit more than you did. So now you got to decide, do I really want him? And you might think, yeah, I do. And you might think, well, gee, look, maybe he's worth more than I thought. And, all this stuff goes on. So it's a little disconcerting that the market maker is cared about supply and demand. They don't care about how well the company is performing. Not one bit. They don't care about whether they're getting sued or whether there's a problem. None of that matters to a market maker. Of course, conversely, if everyone's trying to sell the stock and no one wants to buy it, Enron sucks, and so everybody wants to sell their Enron. Well, I don't want to buy it. How are you going to convince me to buy Enron? We'll put it on sale. Maybe it's worth buying here. Maybe it's worth buying down here. But the neat thing is often this is very emotional. You can just tell by these people raising their hand, and you can tell that the market, if you go there live, a lot of it's done electronically now, but in the old days, like, in Trading Places with Eddie Murphy, it's a pretty ruckus place, a lot of emotion there. And it's kind of nice because it can provide buying opportunities for you and I, especially when things drop unnecessarily. If it's just emotion that made the stock drop, oh my gosh, and it's got good fundamentals. That's one of the most exciting times for me is where I see a company with good fundamentals drop because of emotion and because of technical trading, right? It's become more important than ever to understand what we call price action. And in this course, we're going to look at technical analysis, or what we call analyzing this price movement that happens with this supply and demand. We're going to analyze this in three ways. We're going to look at basic chart patterns that help give us insight on how people feel about a stock. We're going to learn to speak that language. We're going to introduce Japanese candlesticks. Maybe we'll do 10, 12, 15 patterns there. And then we'll talk about other technical tools. And I'll tell you, you get into those technical tools, there's a million of them, man. There's so many. And you just find the ones you like, understanding that none of them are crystal balls into the future. So let's set you up with software. Let's just get a first baseline going before we get too much into chart patterns. There's two types of softwares you'll choose from, web-based and client-based. Web-based, I don't have them in black and white for any particular reason. That's just how it went. These are all web-based. So here's three, and I'm not plugging them. There's a lot more in MarketWatch, Google Finance, Yahoo, whatever, FinViz, and so many others, Finbox. There's just a zillion places in the information age to get this information. So my trading partner Corey, he'll still use old StockCharts.com. That's what he'll use. I don't use that. He does. It's just, you'll notice the information's the same on all three, right? Whatever you get your stock charts, the information won't change. So this is a lot like Ford or Chevy. Some people are going to say, oh my gosh, Ford and Chevy are complete opposites. There couldn't be a bigger difference. And someone on Mars looking down that doesn't have a impassioned care say, oh, look at these little things with four wheels and a steering wheel and a radio, and windshield wipers and tail lights and headlights. And, to a Martian, Ford and Chevy are identical, really close. To an impassioned Ford or Chevy driver, they're every bit of difference in the world. So I will tell you this, if you like Yahoo Finance chart better than the stock chart or the MarketWatch chart or the Thinkorswim chart or the interactive brokers that I have here, and they're all the same charts and they give the same information. What a client-based is you don't go to the World Wide Web. See how there's nowhere to put www.something.com? See, these are all in a browser, aren't they? Every single one of these is open with a browser. These don't have a browser. They're just connected straight through. So you might have an email client program or some other client program that you log into that doesn't use the World Wide Web. This stuff is all web-based. It has a .com at the end of every one of them. You use a browser. You could use the same browser to look up Facebook, and the same browser to run Google, and the same browser to do all this. It's just a place you go on the internet. Here it comes to you on your computer. So there it is, client-based. Won't spend a lot of time on this. I have a class that I'll probably revise soon called the Beginning Investor Boot Camp that'll deal with this more. So we'll deal with that more in the Investor Boot Camp. So one of the things we'll want to consider perhaps is our time frame. You have miles per hour, right? Well, you can also have prices per hour. How much ground do I cover in an hour? That's miles an hour, or feet per second, right? How much does the price move in a month? Or how much does the price move in a day? How much does the price move in an hour or millisecond or nanosecond? And so I'll give you my preferences, not to say one's better than the other. It's really about what you enjoy. But most of the trading I like is here because I'm lazy. I don't want to sit at my computer all day and go buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. I don't want to get in all those emotions, and I don't want a job. So I like the idea of taking a position, particularly an option, for probably a month. I love to sell options a month at a time and make adjustments and check in maybe once a day. But I don't want to sit at my computer all day. That's not a life. Swing traders might stay in a trade weeks or days. Day traders look every hour and minute. And then you have, and the harder, the more you move this way, the more work this will become. And the ultimate work is done by computer in what we call high frequency trading. We used to call this scalping before we had computers to do it. And this is an important conversation we're going to spend a little time on because I'm going to do my best to clear up some confusion. Right now, high frequency trading is truly the trend. It is taking over Wall Street, in my opinion. If you'd like to read a book on high frequency trading, I recommend the book Flash Boys by the same author that wrote The Big Short. And Flash Boys starts out, this is not a spoiler, it's how the book starts, so I won't spoil it, but Flash Boys starts out with these guys are digging a tunnel through the city. And they're going through buildings. They're just, it's a straight line. Because what happens is if you have artificial intelligence, AI, and you have algorithmic trading where you're looking at micro movements and analyzing behaviors in price action, speed is all about it now. And what you'll do is you'll leverage $1 zillion to try to get just a tenth of a millionth of a second going here, and just even less than pennies. In the Forex, we have something called a pip, which is a hundredth of a penny, right? It's just very, very small movements in the prices. Stuff that you and I wouldn't care about. If you had $1 million account, you wouldn't care very much about these little micro movements because they don't make you hardly anything. But if you have millions and millions and millions and millions of dollars, well, and then they're leveraged on top of derivatives, and okay, now these movements can really matter if you have enough leverage behind them. And so the reason I'm going to spend a little time on this, and I hope you don't mind if I spend a little time on this is really, there's been a debate that rages for years and years about which is more important, fundamental analysis or technical analysis, which is more important. And some people say that fundamental analysis is not valid because it's all about supply and demand anyway. And that really, there's a lot of truth to that. Look, if it's just about supply and demand anyway, why not just study that part? Because at the end of the day, the supply and demand is what decides the stock price, not the fundamentals. So these guys are like, Buffett and Graham, that's nice in the 1920s and maybe even up into the 1980s. But today, look, it's about price action. And there's a lot of truth to that. And I think the thing that has validated the technical analysis stance more than anything else is the amount of high frequency trading. There's some people are estimating that now 70% of the trading that goes on in a day is algorithmic and done by a machine. Think about China and Google, how Google's given all their technology to China now. I don't know how the U.S. feels about that, but China is tracking movements with facial recognition of all of their citizens now, and they track where they go and what they do and what they spend. It would not be beyond imagination for you to walk into a store and have that store know what your preferences are because they've tracked you and they understand you and they know what your buying habits are. You might have noticed already that you might have Googled something and been interested in buying something, and the next thing you know, all the Facebook ads you see are about that item. Well, how in the hell did Facebook get that data when you're on Google, right? How did that work? Well, it does. And if you believe in AI and you know anything about artificial intelligence, it becomes pretty smart pretty quick, and it can begin predicting. It can predict where you might go. It might predict what your day might be like, what type of coffee. These algorithms based on habits and behaviors and past and how people react, they become very, 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 very powerful in this. Well, this is where doing the work is worth it because you got a machine doing it in nanoseconds and they're clipping little profits. Now this is harder for a machine to do in a long time frame. It's hard for a machine to predict where things will be 20 years from now because there's so many anomalies that could happen. But it's not hard when you get down into the very nanoseconds, as hard for a machine to begin to predict and do buys and sells. And they're not perfect, but they just have to have more winners than losers. And the trend, there's no question that, people used to say, oh, these candles are just tea leaves and these patterns don't matter and you really can't figure out what the market is likely to do. This is just a bunch of tea leaf stuff. Well, I would say that, I've always been a strong follower of technical analysis. I've done enough of it that I really have seen enough support and resistance work out, and enough bad news that gaps to a support, or enough good news that's limited by resistance, and I've seen enough breakouts of ascending triangles, and certainly there's some Forer effect and some Barnum effect, some fortune cookie, astrology type psychological traps you can fall into. I've seen a lot of dojis that don't reverse. I've seen a lot of failed breakouts too. But I've seen enough of both sides of it that I always felt that technical analysis was legit. And now that the computers are taking it over, they've shown it really is legit. Read Flash Boys. You don't spend, hundreds and hundreds of millions of dollars on technology and, straight line fiber optics, because if your fiber optic is straight and the competitor's fiber optic has a jog around a building, you're going to beat him in that nanosecond when you're dealing with the speed of light. So this is what we deal with. Now, so the first point I would make, why I'm going to spend a lot of time on this, is that this stuff's real. I mean, you just don't have the amount of algorithmic trading out there. If it wasn't working, they wouldn't do it. They wouldn't keep pushing to get better at it. Most of the trades are made this way. Okay, now the myth is that I've heard people that don't understand this very well say, look what you're competing against. How can you compete against a computer? Well, you're playing a different game. The computer is not very good at the years or months game, or even the days or weeks game. It's really good in the micro and nanoseconds game. It's really good at these micro movements. And they say, well, this is going to affect how you trade. Look, I don't really care if these algorithmic, and high frequency trading machines make a stock go up, well, it's still going up, right? And they can still go down. Well, guess what? Stocks could go up and down before these machines were around, right? I have to have the same risk management in place, because it could be something other than a machine that makes it go up, and other than a machine that makes it go down. Not just their own supply and demand. News matters, right? And fundamentals still matter to a degree. Now, you can see that the fundamental state of a company is not going to change in a microsecond. Their earnings, their growth, whether they're solving their lawsuit or not, that doesn't really change in a microsecond or nanosecond. So it has zero importance to the high frequency trader. And it might have a little bit of importance, especially sovereign fundamentals. It can have an effect during the day if something changes, but it has a much bigger effect still in the position in the swing. So don't get caught up in the idea that, I can't compete with the machine, because you're not playing that game. Actually, the machine would struggle to beat a Warren Buffett over the next 20 years, in my opinion, because it's too much. You'd have to make so many adjustments. So that's why they do it in nanoseconds or microseconds. So don't buy into this stuff that, you can't compete with the machine, man. You're not competing against them. What are you competing against? They're winning, you're losing. Look, if they make it go up and I'm bullish, we both win. If they make it go down, I'm bearish, we both win. So it isn't like if they win, you lose. You can win right along with that machine easily. So that's an important thing to know, and it's the world we live in, and it's an exciting thing. Because technology is, Arthur Levitt, former chairman of the SEC, said this. He said, this generation of investors should be the most informed generation in the history of our capital markets. The ease of today's technology is a mandate to do more, not less, to do more as individuals and as a country. So, techno fright has never been a good thing for people that want to be successful. When people say, well, I've never needed email before, and I've never needed the World Wide Web before, and I've had my business here, and I don't need an e-commerce website, and I don't need a Facebook page. Guess what? Those people lose. So invite technology, use technology. It can be easily learned, and that's a little bit on time frame. So let's finish up this segment and just learn the first basics of chart patterns. And you have basically three directions a stock can go. They can go up, down, and they can remain the same, and stagnant, go sideways. So the story of a stock and the story of supply and demand is going to make up some combination of those three directions. They will go forwards, not backwards. And as they go forwards, they'll either trend upward, trend downward, or stay the same. That's the only three possibilities. So the first lesson in technical analysis is to begin to identify, well, what is the definition of an uptrend when there can be little micro ups and downs between. So for our purposes in the 4 pillars of investing, this is how we'll do it. We have support and resistance. That is the first language and the first nomenclature, or whatever you want to call it, the first jargon that we use in this technical analysis that's so critical. And the good news is remember how, you know, we in fundamental analysis, we opened up the book The Intelligent Investor by Benjamin Graham. And in that book, Benjamin Graham said, you know, we've looked at all these mathematical equations and models for value investing, and after reviewing all this fancy stuff, we've come down to say that fundamental analysis and value investing is really about earnings and growth. Remember that? And we have our little formula here that's very simple: earnings and growth. Well, let me tell you what I believe. I'll say the same thing about technique. Man, you can get all these indicators and Chaikin money flows and Elliott waves and Fibonacci retracements and just everything under the freaking sun. But I will tell you, I use support and resistance, and I think I speak for many, many people that you know, support and resistance is just a big deal. So support is saying yes, that's a yes vote, and resistance is when you say no. It's that simple. So do you support that candidate? Yes. Do you resist his policies? Yes, right? So support and resistance is about yes and no. When a price is low, people tend to like things on sale, and when prices are high, people tend to say no. So what happened here is the only thing that can make this travel and continue to travel is if the next guy is willing to pay more than the previous guy. And so a guy or girl comes in and buy it, and in order for that thing to go up, someone's got to offer them more. And then someone's got to offer them more. And someone's got to offer them more. Until finally they keep selling, no, I'm not going to pay that much. And then all of a sudden it starts going down until people say, well, that's pretty cheap. And then people say, okay, I like this. And this is a critical point here. Notice that they went from saying no to yes right here. See that? Right here before it was a no. Now that's an important point, because this is a change in attitude. See that? So stock charts tell a story, and I can tell you right here that story changed pretty big and pretty powerfully, right? There was a change where we went from no to what? To yes, right there. And now we continue. Now there's a new no. Not surprising when it came back that this is where they started to say yes again, right? So as we tell the story, support began increasing and resistance was decreasing, right? We began to get higher and higher and higher, and so this is the definition of an uptrend. And we call this little movement where they say no and yes and no and yes and keep going, we call these new highs and new lows, or what we call swing highs and swing lows. In other words, we get to a real definitive point where it was higher. Now we might have little things in here, but here it's higher, and boom, we now have a definitive point where it was high, boom, a definitive point where it was low. So we call these swing highs, and of course we call the values swing lows. So hopefully that's simple. If it looks like a mountain peak, it's a swing high. If it looks like a valley, it's a swing low. So if you're in the mentor club, I can't imagine a mentor club going by without us talking about support and resistance. I just don't think it would ever happen. In the years and years and years we've done the weekly mentor club where we look at real stocks and we start doing this for real, we're going to say support and resistance over and over and over, and it's likely to say, look, we got a new swing high or a new swing low. So that's our first definition. The definition of an uptrend is very simple. It's when we have higher swing highs, we've got to underline that whole thing, higher swing highs and higher swing lows. In other words, the highs are getting higher and the lows are also getting higher, and that creates a channel called an uptrend. So if you've printed this out and you're taking notes, you could draw that channel. And often you'll see that this is called a trend line. And a trend line is simply when we pick the bottom or the top or both, and we connect the tops or we connect the bottoms, either way, and we begin to have a straight line here. Now this is not a trend line, right, if it's all over. But if we can see that there's a consistency to this trend, now we can kind of get an idea of where these might hit and where they might peak out in the future, because we kind of understand the story of the stock. And they can always change, just like fundamentals. They can always change. Again, we're not trying to predict the future. We're trying to gather intel of what it's doing right now. Please, please, I know I harp on this all the time, but the more I've done this, the less I think of this as a crystal ball and having to be sure and secure about a future. I'm very, very comfortable, and so will you be, with the idea that the trend could change tomorrow. But again, I'm gathering intel. Let's decide, and again, what is an intelligent investor? Well, what is Intel? Well, what is the Central Intelligence Agency? They gather information. Information age. Everything is about information. It's about making the best decision you can based on the information you have. Now, an unintelligent investor would make decisions without information. An intelligent investor would make decisions with information. It has nothing to do with the outcome. If someone says, boy, that wasn't a very smart investment, no, it might have been a very smart choice. It's just bad luck happened. Someone gets married and they have this great marriage, and all of a sudden she develops cancer and she passes away. And someone says, well, that was a bad choice. What are you talking about? It's not a bad choice. It's bad luck is what it is. And that's why we have the risk management pillar. The more you do this, the more you'll learn that I rely on my risk management pillar. The fundamental and technical analysis is not where I find the feeling of safety to move into the trade. It's where I find the feeling of intelligence moving into the trade. Okay, great. I'm moving into this trade because I have intel. I see it's strong fundamentally. I also see it's in an uptrend. Looks like it could have another hop right here. That's all I'm saying. Not guaranteed to have it. Go down like a rock the next day. Bad news. So the comfort we find in fundamental and technicals is we say, look, we are at least making a decision based on data and reality rather than gut feelings and tarot cards and superstition and a fortune cookie and a horoscope. Okay, we have data. We're intelligent investors. Where we feel comfortable, though, is in our risk management, knowing that, hey, if things change, it's okay. The problem with fundamental analysis and technical analysis is school teaches us that we can never be wrong. The mistakes are fatal. You get big red marks on your paper, and we're always trying to be right and saying, look, we want an outcome that's positive every time. The sooner you shed that immaturity and that pubescent idea, the better off we might be. To just say, look, things change, deal with it. That's investing, right? There's risk there. Hallelujah, we got risk. And so a downtrend, of course, is lower mountain peaks and lower valleys, and we can connect those dots and create downtrend channels, right? Downtrend channels. And of course, a sideways trend is when we draw these and we have a channel. We call this a stock in a box. And so we might use a time decay strategy here. If we see this stock in the box, hey, it can break down or break out at any minute. But at least we're gathering intel to seeing, well, what's its trend right now? And so that's a huge thing. It's not like a football game on ESPN. The more points the other team starts scoring, the lower your chances win the game are. But man, I'll tell you what, watch the Super Bowl a few years ago. Things can change. So the chart is reality, and we trade with the trend. And no matter what, I'm still going to make a case for fundamentals. Why would I spend 7 hours in just a basic course on fundamentals if they weren't important? They're critical. I love being a fundamental value investor. I love that intel, especially as a position trader over a longer period of time. Some people say, oh, there's a difference. Investors never sell and traders always sell back. Get out of that. Look, we're investing our money in something, whether it's for 20 years or 1 minute, it's still money going out, still a trade investing. I don't get into that change of, this is investor and this is trader. Look, I'm a trader, I'm an investor. If you're an investor, you bought your stock at the New York Stock Exchange or the Chicago Board of Trade, you traded money for stocks, so you are a trader. So the chart's reality. We don't get to choose the trend, but we can choose our strategy. And so this gives us power. So when we come back in the next segment, we're going to talk about reversals of trend. It's very easy or it would be very easy in theory to say, oh, it's an uptrend. Okay, I'll buy it here and it'll just go up forever, right? And then I'm fine. You know, oh, if it's a downtrend, I'll go short and they'll go down forever. No, these change. These change. And so George Soros, one of the best technical guys ever, said, look, we're going to catch new trends. And in the later stage of a trend, we try to catch a reversal in the trend. So we'll talk about that idea of when these change and how to recognize when they change and how we might position ourselves to benefit. I love having you in the 4 pillars of investing. We at the Cashflow Academy love our students. And so we hope you're gaining a lot of insight, especially for the new traders, to think about these things. And even the old guys like me, it's never unhealthy to go back and say, you know, what really is a trend? What does this really mean? What is the story that this stock is telling me? We'll be back with looking at some ways that trends reverse in the next segment.